Hello everyone. In today's video, I'm going to be showing you a real life example of how to use the fair value tool on our site and why it's such a valuable tool for you. Basically a game changer. It's going to save you a lot of time and basically helps you stop guessing what is the fair value and how much should I pay for a stock. So when you identify a stock that you are interested in, the question always becomes, what is the fair price for this stock? There is a big difference between a good company and a good investment. Let me give you an example. So let's say you identify a current trend right now, AI, and you want to get exposure to the sector. So you look for companies that are exposed to the sector, and let's say you come across one, and I'm going to show it on my screen right now. It's called TE Connectivity. Basically sell products to data centers, and obviously data centers are essential for AI. So it can be a good company, right? It's profitable, it has strong free cash flow, but the question is it a good investment? And the answer can be yes or no. It depends on the price you pay. If you overpay for a good company, then it's not a good investment because you're not going to make a return on that investment, right? Conversely, a company could be bad, but if you pay a good price for it, it could become a good investment. And then there's a third scenario where the company is bad and it's a bad investment. So, as an example, typewriter company. Let's say one existed today. Obviously, if even if you bought the company for $1, it's a bad company, it's a bad investment. Why is it a bad company? Because not many people, or maybe nobody, uses typewriters anymore. So it's a bad company. Why is it a bad investment? Because even at $1, which is cheap, it's unlikely to ever go up in value because nobody is, again, buying typewriters. So you need to identify a good investment. The best way to do that is to pay less than what the company is worth. And so, one of the most accepted ways to evaluating a company is using a tool called discount cash flow analysis. And I'm going to walk you through an example right now using this company, TE Connectivity, which I invested in, sold it at a profit, and it's continued to run up. So this is not a lesson on timing. It's basically how I was able to make the decision to invest in it and then get out. And I'll walk you through the steps that I took to do it, and now how you can save time using our fair value model so you don't have to go through this laborious process to do it. So here's my spreadsheet. Um, TE connectivity is the subject of this video. So the first input that we need is the EPS growth rate. This is essentially my proxy for cash flow growth rate. And the way to do that is to see what the consensus numbers are from the analysts. You can develop your own forecast, but again, if the analysts are going to do it, you know, take the path of least resistance is a shortcut. So I have on my screen right now a database that we use internally when we're doing due diligence on a company. It's called S&P Capital IQ. This is thousands of dollars to subscribe to a year for most people. And so most people don't have access to this, which is another important reason why using our fair value model, you bypass having to obtain these estimates yourself. But let's say we're doing it the labor intensive way, and we're going to calculate the fair value on this stock ourselves. So we look at the earnings growth rates estimates. You can see here at the bottom. And what I do is I just take an average of the next 3 years. So we have 26.27% plus 11.85% plus 11.84% divided by 3, and we get an average 3-year earnings growth rate of 16.65%. So we enter that here in their spreadsheet, okay? And you'll notice that um, when the earnings growth rate, what I had here previously was 9.56%, the fair value estimate on the stock was 163.15. When I increased that to 16.6%, you can see how it affects the fair value. So now you can see why when analysts raise or lower their growth estimates on a stock, why the stock goes up and down, right? So this also gives you an intuitive sense when you're watching CNBC or whatever news you follow, why analysts revise their targets up or down based on the growth rate estimates, or why stocks go up and down based on growth estimates. This one is easy to get. Next input is the current price of the stock. You need that because that is the price that you would have to pay if you invested in this. So we can see here it last traded at 235.79. So we enter that here, 235.79. So right now you can see that the fair value is 217.35. The current price is 235.79. So the expected return is negative 7.82%. But we're not done. We need to enter some of the cash flows and the estimates on the stock. So we go here to the cash flow statement, and we see that in the last 12-month period ending December 26, 2025, this company, let's do last 12 months and most recent quarter. Okay, cash from operations, $4.1 billion. It says 4,126, but if you look here, it's in millions, so you need to add 6 zeros. So 4,126 minus, so in the simplest sense, free cash flow is cash from operations minus capex, which in this case was $989 million. So we subtract that, and we get $3.137 billion. So we're gonna enter that here in our spreadsheet, last 12 months, 3137, 123, 123, and that's in billions. Okay, so now the rest of the spreadsheet, I'll explain to you what's going on here. In the last 12 months, this company generated $3.13 billion in free cash flow. Now we're gonna forecast the free cash flow out 5 years from today. So how do we do that? Well, we have our earnings growth rate, which we're gonna use as a proxy for the free cash flow growth rate. And so we're gonna increase this last 12 month free cash flow that they generated by 16.65% a year. So in year 2, we're forecasting 3.6 billion in free cash flow. Year 3, 4.26 billion. Year 4, and so on. And then we have this terminal value. It's basically, we forecast the cash flows out 5 years, and then obviously the company would still be around after 5 years, so we need the value to infinity, which is technically what the terminal value is. Now when we do this, we have a fair value estimate of 246.43 versus the current price of 235.79 for an expected return of 4.51%. We're not done yet, okay? So now we need to make sure the shares outstanding is accurate. So we go here and we check what's the shares outstanding, and it's 293,400,000 shares. So we update this 293,400, and you'll see the fair value will increase by $3 because obviously if the shares outstanding decreases, the value of each share goes up. Next, we need to make adjustments for the capital structure of the company. So total capital right here, 19.138 billion. We enter that here, 19.138, okay? Total debt. And I'm not gonna go into why we're adjusting for the capital structure. I'll take that up in a later video. Okay, and then last input we need is total cash on hand, 1.251 billion. 1.251 billion. 1, 2, 3. 1, 2, 3. Okay. So, what do we have? When we make all these inputs that are necessary for the discount cash flow model, our model spits out a fair value estimate of 243.49 versus the current price of 235.79 for an expected return of 3.27%. So, should you invest in this company? Well, I can't really tell you. That's up to you to decide. It's based on factors like your risk tolerance, your goals, your time horizon, etc., etc. You should speak to an advisor. But based on this, I would say that if the expected return is 3%, you have to look at what can I get elsewhere in the market. If you can get a bond risk-free, let's say, from the US Treasury at 6%, does it make sense to invest into something that has risk and is only expected to return 3%, right? So again, you need to make those types of calls yourself. But now that you kind of see what's required to do a valuation on a company, I want to show you an easier way to do it. So go on our website, researchfrc.com, click on the search bar. Now just enter the name of this company. So TE Connectivity comes up here. And click on fair value. And the work is done for you. So we see here the current price, $235.79, and the fair value, $274.32. So why does it differ between the spreadsheet and what's in the model? Numerous factors, growth rate estimates, different various inputs can vary, right? But the important thing is that all that work that we just did is the same work that's being automated behind the scenes on our platform so that you don't have to do this calculation. So let's say historically I was interested in 10 different stocks every day. I would basically use a spreadsheet and calculate the fair value manually. It was labor intensive, took time, but now I can just look up the 10 companies on our website and get the fair value estimate. So obviously it's not guaranteed that it's going to hit this target price, but this is just one tool that you can use to help you, is it overvalued, is it undervalued? So another way to use the tool is you can now screen for companies using our screener here and try to find which are the most undervalued companies based on this fair value model and which are the maybe most overvalued if you're shorting. So many ways to use a tool. That's a topic of a future video. But for today, really, I just wanted to show you an individual stock. If you're going to be looking up, if you're interested in an individual stock, what is a quick way to determine whether it's underpriced, overpriced, or fairly priced? And the best way is through the FRC fair value model. So I hope you learned something today. Go to our website. You can test it out. If you sign up for a free subscription, you get a limited number of queries. Hopefully you find it useful and subscribe for the premium subscription. If you have any questions, leave it in the comments, and until the next video, hope you find the tools useful.